Thank you for listening to the Real Estate Voice podcast. I'm Vernon R.E. Jones, managing broker, owner of Jones Homes, and for 30 years, we have serviced the 7-county Denver metro area. Let's talk about what a 1031 exchange is. 1031 exchange is a common tool that investors use so they can delay paying their capital gains. Anyone new to real estate investing may hear some terms thrown around that they may not fully understand. One of those terms is the 1031 exchange, which is a very common tax strategy that can help real estate investors expand their portfolios and raise their net worth. Planning to sell an investment property and want to defer paying a barrage of taxes, including capital gains? Here are the answers to common questions surrounding the 1031 exchange. 1031 exchange sounds obscure, but the concept is fairly straightforward. The term 1031 exchange gets its name from the Internal Revenue Service Code 1031, Section 1031. This section allows for the seller of an investment property to defer paying capital gains by using the proceeds from that property to buy a replacement like-kind investment property. What are the benefits? As an investor, there are some reasons why you may consider using a 1031 exchange. You may be seeking a property that has better return prospects, or you may wish to diversify assets. The benefit is that an investor wouldn't have to pay taxes on the capital gains, aka appreciation, on the property. That means they can keep usually upward of 20% of their appreciation and use it towards their next property. What are the requirements? There are rules and regulations to be aware of when doing a 1031 exchange. And experts recommend consulting your accountant before pursuing this type of transaction. I agree with that. The real property you are purchasing should be like-kind or also be used for investment purposes to the one you are selling. The IRS says properties are of like kind even if they differ in quality, grade, or are improved or unimproved. For example, an apartment building would generally be like kind to another apartment building. The like-kind exchange does not have to take place simultaneously, and that a delayed exchange can occur while one party decides what home they want to receive for their old home. However, a qualified intermediary is required to facilitate the exchange and must be a non-related third party, which means the intermediary can't be an agent, broker, accountant, lawyer, banker, etc., who has provided you tax, legal, accounting, or financial services in the past 2 years. There are other rules that you have to stick to. You have 45 days to identify in writing a replacement property and 180 days, 6 months, to acquire said property. Who can qualify for a 1031 exchange? People with investment properties qualify for a 1031 exchange. Any investor, owner of income-producing property can qualify for a 1031 exchange into new income-producing property. Personal property does not qualify. Has to be real property only. Well, how many times can I do this? Basically, there's no limit on how many times, or how frequently an investor owner can do a 1031 exchange. Still, the question of how often is a gray area in the IRS code. This is another reason why consulting your accountant is a must. It should be noted that a 1031 exchange does not eliminate capital gains. It only defers it. You will eventually have to pay capital gains when you sell the real property for cash. Well, what if the owner decides to make the investment property their primary residence? Well, a couple people says how owners who make the investment property their primary residence won't meet the requirements of a 1031 exchange. And it could and or should trigger current capital gains tax. If they hold it as an investment for 2 years, then convert it to a primary residence, they will end up with a transferred basis from the old relinquished property, which could still trigger capital gain on a primary residence if the gain exceeds the threshold for tax exemption for primary residence sales, which is $250,000 for singles and $500,000 for married couples filing jointly. How does a 1031 exchange affect house flippers? Good news for house flippers, they qualify for a 1031 exchange with a few conditions. The property must be owned for 2 years for it to qualify. So if owners flip too fast, it won't work. Due to the relatively short holding period for a flipper, it is unlikely that the house achieved a significant appreciation to warrant the use of the 1031. But there are no disqualifications for being a flipper. Understand, again, own it for 2 years or it just won't work. You can keep on exchanging into another property to flip. However, you run into the risk where the price of your exchange property will continue to go higher. The thought is about 1031 exchanges is they are a great opportunity to go from a single family home to a duplex, to a fourplex, to an eightplex, and on up. The goal is the property has to be like kind, in other words, being used as investment. And you can find that the 1031 exchange can be a very, very valuable tool. I have done multiple 1031 exchanges in my 30 years in the business. And I would advise anybody considering doing it, please talk to a tax professional that can guide you. But it's pretty easy once you understand the limitations that are within the 1031 section code for 1031 exchanges. Any questions about this? Feel free to give me a call at 303-359-8218 or your tax professional. Thank you for listening to the Real Estate Voice Podcast. I'm Vernon R.E. Jones, and as always, please be safe.